recording here. You're probably hearing the tornado sirens going off in the background. The only other thing I got to do is make sure you guys can see my screen. So we'll grab that quick, share that, start getting some of this other stuff out of the way here, and we can go in, dive into the presentation. So let me know if you guys can hear me. I'm going to turn on my iPad here real quick and just see that I can get my, make sure the video is all working and going out, because we're using Zoom. So within the last few weeks here, we've been having some issues with our other software, and decided to go ahead and go with Zoom. And oops, there we go. So let me know if you guys are seeing this, because I'm not getting any kind of alert or anything that I'm live. So let me just see. All right, looks like I'm seeing some comments here. Must be a little bit more of a lag than usual, but awesome. Okay, you guys can see me. All right, that's all I need to know. Now I'm going to go ahead and get started. So today we're going to be talking about the unconventional way to beat 89% of investors. We have this good graphic here of Usain Bolt crushing everybody in the 100-yard dash in the Olympics. And I really believe when you invest in a rational, logical, mathematical based way, that's kind of what it feels like. It's kind of like you have to run a 100-yard dash with a 10 or 15-yard head start, and it definitely helps. So as we get going here, I'm going to be using a lot of quotes. I'm going to be talking about things that a lot of other investors have said. So the first one I want to start off with, it's kind of a fill in the blank. I'm going to reveal it a little bit later on, but Charles Schwab, the guy that founded Charles Schwab, the big discount brokerage shop, he had this quote where he said that he was asked about how he invests personally, and he said how he does. I'm more of a blank, and I'll explain what he said, but he said the predictability is so high. For 10, 15, or 20 years, you'll be in the 85th percentile. So before I reveal what it is, let's just take a second. When he says 85th percentile, what that means is if we had 100 investors in a room and you were in the 85th percentile, your performance was better than 85 of those investors. So there's still, 14 that beat you or whatever, but you're well ahead of the vast majority of investors. I'm also going to share a lot of data today from a lot of different sources, but one of them is from Yale's endowment fund. So David Swenson, he's the chief investment officer for Yale. He actually says that this way of investing will likely put you in the 96th or even 98th percentile, which is a little bit more in line with what I believe. But first off, let's say what we're basing all these numbers on. When we say, hey, you're going to beat 85% of investors, you're going to beat 96% of investors, all that type of stuff. It's really all coming from this Dalbar report. So Dalbar is an organization that every year they release this quantitative analysis of investor behavior. The 2020 report is out, and what they basically show is over the last 30 years, if you were invested in the S&P 500, you got 9.96%, but the average equity investor, drum roll please, got 5%. Now that's crazy. You're an equity investor, whether you're in an ETF or a mutual fund or even individual stocks, the average investor, and they look at a lot of them when they make this report, got 5%. Now we're going to talk about where that gap comes from and how to close that gap, but this is not what we're using when we say outperform the average investor. We're actually using this number. So the average investor over here on the right, when you include all their stuff, their bond funds, their cash holdings, their real estate, all their overall allocation, the average investor got just 2.29% per year for the last 30 years. So think about that. I put inflation in there just as a benchmark. Inflation over the last 30 years is 2.4% a year. So if you got 2.3% and inflation is 2.4, you actually move slightly backwards. Okay, so let that sink in for a minute. That's when we're talking about the average investor, that's what we're talking about. And let's see what explains this gap. There's this big gap here from 2% all the way up to 10% a year. One of the biggest differences is fees. The average investor in the United States is paying 1.75%, 1.75%. They're paying 1% to an advisor, and they're paying about 0.75% to a mutual fund. If they're owning things like variable annuities or life insurance, the fees are actually much higher than that. The average variable annuity is in the 3 or 4% ballpark, but fees make up a huge amount of ground inside that difference. Another big one is cash drag. We have quite a few videos on this subject. If you haven't checked out our YouTube page, highly recommend you go do that. Cash drag basically means you're not fully invested. So maybe you have a whole bunch of money in a brokerage account and a whole, third of it is set aside in cash and not invested. We're going to go through in this presentation today and show you how much that's actually costing you and how you should really look at it kind of like an expense that it really is. But also a big part of that gap is taxes, especially if you use things like mutual funds that distribute capital gains and different things like that. Or if you're just not doing the best tax planning inside of an IRA, the taxes will eat up your results faster than almost anything. And the Ivy League knows this. I mean, if there's anybody that understands taxes, it's the Ivy League. They're set up as nonprofit organizations, and they have some of the best and brightest in the world, obviously. And David Swenson, the chief investment officer of Yale's endowment, they ran a study. So this is not someone else's. This is his study. And they said 4% of funds, mutual funds and hedge funds, produce market-beating after-tax results. Okay, so if you include taxes, 4% outperform, and the ones that outperform an average of 0.6% per year. The 96% of funds that fail to meet or beat the Vanguard 500 lose by a wealth-destroying margin of 4.8% a year. So the very rare guy or gal that outperforms the market, they win by a little bit. They win by 0.6% or something like that. And the vast majority of people trying to do it lose by 4.8%. So it's just really a gamble that's not really worth taking to begin with. But then also we're going to show you, how it's actually a little bit more predictable than you might think. And another big part of this gap, so the gap between the investor earning 2% and the market getting 10%, is trading. So there's a statement here on the screen that investors underperform their own portfolios. The first time I read that, it was a head scratcher. And I was like, man, whoever came up with this doesn't, they're not getting their idea across well. They're just saying they meant something else, because how can you underperform your own portfolio? But then when you actually dig in and look at the studies, it's actually true, believe it or not. So what I mean by this is if people just stuck with the original portfolio they started with, most of them would have better results than all the switching and changing they do. So there's a really good study from, I'm going to butcher the name, but Charles Trzynka, professor of finance at Indiana. The article is What Fund Investors Really Need to Know at Money Magazine. And so this is not even looking at active management. This is just looking at the biggest or the magnitude of the difference between how the average fund does and the average investor. So the difference is shocking. The funds average 5.7%. The investor captured just 1%. And that's per year. So this was over a 4-year period, I believe. It wasn't over a longer 20 or 30-year period. That's why the numbers are different. But what we find is the more volatile the market gets, the more trading hurts you. So when the market's swinging 5 or 10% a day, that trying to time it becomes more and more detrimental. And there's a crazy story of the CGM Focus Fund. If you ever go Google it, it was the top performing mutual fund in the United States for a decade. It did something like, I think 19% a year or something like that. And the average investor in the fund lost money. Okay, because they were piling in at the top and they were piling out at the bottom. So Charles Schwab, what is he talking about? What's the strategy with high predictability, 10, 15, 20 years, you'll beat 85% of investors? Well, he's an indexer. Believe it or not, his money that's outside of Charles Schwab's stock, because he obviously owns a huge percentage of Charles Schwab, but his money that's outside of Schwab is invested in index funds. And it's a huge percentage of his portfolio is just invested in index funds. And I know what a lot of people on this Wealth Wednesday are probably thinking right now. They're like, hey, we were going to talk about outperformance. I wanted to know how to beat 89% of investors. What's this index fund stuff? And I am talking about outperformance. What I'm talking about is the average investor is falling so far behind the index that if you just get the index, you drastically outperform the vast majority of investors. And again, Charles Schwab says you'll be in the 85th percentile. Yale says you'll be in the 96th percentile. The full data here, and I'm going to have to, I don't want to risk, it's not, here we go. it's not going to let me drag my face here. We'll go like this, and then we'll drop back into here. Okay, perfect. If you look at all domestic funds, so this top line here is every mutual fund in the United States compared to the S&P 1500, which is big companies, medium companies, and small companies, 89% of them underperform the S&P 1500. If you look at the row right below that, that 90% number, if you look at all large cap funds in the United States, compared to the S&P 500, 90% of them underperform the S&P 500. So a little bit tougher even benchmark to beat. And as you go through these, there's 92s and 93s and, different things like that. But on a 20-year, it gets worse. On a 30-year, it gets worse. And the further out you go, the more of these funds fall by the wayside. And my question is, you're probably going to be invested for 30 years. A lot of mutual funds, believe it or not, don't even last for 30 years. Something like 3 to 5% of them get closed down every year. So over the long haul, how can you be a long-term investor if when your fund goes on a 3-year bad run, they're just going to close it down, throw you over into some other fund, and you're paying a lot of fees along the way. So that data point, so that table I just showed you is from Spiva. So we've covered, Charles Schwab says he'll be in the 85th percentile. Spiva says he'll be in the 90th percentile. David Swenson says he'll be in the 96th percentile. And what I wanted to originally call this Wealth Wednesday is how the average investor can quadruple their returns. And Eric said that was like ridiculous and fraudulent and different things like that, but literally take 2.3% times 4 and you're getting up in the neighborhood of what an index fund did. So the average investor literally is only getting 25% of the results that they could be getting when you look across their whole portfolio, the annuities they own, the real estate that they own, all the different things, cash, everything combined. They're basically keeping pace with inflation over the last 30 years. And if they adjusted their approach, they would do much, much better. So what I want to do is take a quick second and ask, what do the wealthiest people on earth do? So when you kind of look at any field, whether it's, I don't care if it's football, you might want to look at like Tom Brady and Bill Belichick and Aaron Rodgers and different people like that. If you're looking at basketball, you want to look at like LeBron James and all the different people there. And if you look at investing, you want to look at the wealthiest people in the world and say, how'd they get there? And some of it's luck, some of it, there's an aspect of luck involved, especially for some of the people that, when you get further down the list into number like 75 and 100 and stuff, a lot of that's inherited. But when you look at the people at the top of the list and the people that stay at the top of the list for a long period of time, people like Warren Buffett and Bill Gates and Jeff Bezos, there's a pattern. Okay, what's the pattern? Well, I show the portfolios here. Bill Gates has a lot of money invested with Warren Buffett. Warren Buffett has a portfolio here of about 30 businesses. Jeff Bezos is slowly selling off his Amazon stake. He's buying a bunch of other businesses, the Washington Post and Google and all those other sorts of things. Bill Gates here, you can see he's involved in like Waste Management, Canadian National, and Walmart, and kind of a boring portfolio. He's got the Berkshire Hathaway, and a lot of people go, hey, where's the Microsoft? Believe it or not, Bill Gates doesn't actually personally own any Microsoft. Gifted all his Microsoft stock to a charitable organization, and his personal portfolio is 50% Berkshire Hathaway and a bunch of other stuff. But anyway, I'm getting off topic. So my point here, when you look across all of these people, what's the commonality? They all own a bunch of great businesses. So some of them own more than others. Some of them own 50 or 100 different businesses. Some of them only own 5. Jeff Bezos has been very concentrated. He's got a huge percentage of his wealth in one business. Even Elon Musk, who's kind of new to the list, very concentrated, but Tesla does a lot of different things. So his money is very focused in Tesla, but it does a lot of different things. It's in space, and it's in solar power, and it's in cars, and it's in, all these different things. Then he's got the Boring Company that's drilling holes, but all of them, I don't care, top to bottom, the top 100 people, the vast majority of their wealth is invested in great businesses. Okay. And that's, in my opinion, if you want to not only grow your wealth, but protect your wealth, like people say, oh yeah, those rich guys, they have a bunch of money in businesses because they don't care about losing it. They have more to lose. Do you really think Bill Gates wants to lose money, or Warren Buffett or Jeff Bezos? They're doing what they think is the optimal risk reward trade-off. They're just owning a bunch of great businesses. There's a chart on the screen here that you've probably seen. It's from a book called Stocks for the Long Run. But if you go back from 1800 to today, and we look at a bunch of different asset classes, so we have the dollar there on the bottom, it's lost 95% of its value since 1800. Gold has done much better. Gold there, the second one up, It's turned a dollar into $4. Bonds do a little bit better. They turn a dollar into like $2,000 over that period. But look at businesses. Stocks are pieces of businesses. Stocks since 1800 turned a dollar into $700. The Dow back in the Depression was down at like 40, and I don't mean 40,000, I mean 40 points, 40. And now we're up where we are today. Over the long run, these businesses grow. They create more cash flow, they create more jobs, they create more profit. And if you really want to do well and you want to outperform inflation, you want to own a bunch of great businesses. That's what the wealthiest people in the world do. And even if you really like, let's say you really like copper or iron or zinc or aluminum or even gold or silver, some of these things, there's a lot of great graphs out there that you can see. This was a study going back to 1925, and it compared all these different metals to the average metal company. And the average metal adjusted for inflation is kind of flat in regards to where inflation is. Look at how the companies are doing. They're up 9%. Oil's flat adjusted for inflation going back to 1925. Look at oil companies up 8% a year. They know this, those billionaires, they know this. That's why they're owning businesses. That's why the vast majority of their wealth is invested in these great businesses, because they know even if we see crazy hyperinflation of 50%, those businesses, especially those businesses tied to things that inflate, they're going to go up in value. So the big question here that gets asked is, well, if we're going to pick a bunch of businesses, how do we know which ones to pick? I personally am a big fan of this guy. So this is Jack Bogle. He's the founder of Vanguard. He said, instead of spending your whole life looking for the needle in the haystack, just buy the haystack. And I think that's a great philosophy. And you'll see some of the data behind this. So one of my favorite quotes in this whole presentation here is this one, where this person was asked about the best way to own a wonderful business. And he said, in his opinion, the best way to own a common stock is through an index fund. Those following this path are sure to beat the net results delivered by the great majority of investment professionals. Think about that. Index fund, sure to beat the net results of a great majority of investment professionals. Who said that? Might surprise you. Warren Buffett. He said it way back in 1996. And when you look at what you get when you buy an index fund, it's not just some imaginary piece of paper. It's not just numbers on a screen or something. You own a piece of Apple, you own a piece of Microsoft, you own a piece of Disney and Visa. And, like with Visa, you're getting a little tiny piece of every credit card transaction that happens today. Procter and Gamble, a bunch of this stuff. If you go in your bathroom or in your kitchen or different places, there's a bunch of products from all these companies in throughout your home. Home Depot, Bank of America, Intel. If you got a computer, you probably have an Intel product in your home. Berkshire Hathaway, they own a bunch of different stuff. They own Geico, they own Burlington Northern Santa Fe, they own all these just huge businesses. JP Morgan, one of the biggest banks. Johnson and Johnson, they got the vaccine coming out. When you buy an index fund, it's not some intangible thing. You're owning the best businesses in the world. That's the point I'm trying to get across. And my favorite quote in this presentation is right here. This was from Warren Buffett in 1997. So he was asked about that line in the annual report in 1996. And they said, hey, are you really a fan of index funds? And he said, yeah, big time. Investing is the only field where the amateur that's willing to admit they are an amateur can predictably beat the professional. And I think that's really interesting. He's basically saying, if you're willing to set your ego aside and focus on the numbers, you can beat 95% of investors. And I agree with him. So in fact, this might surprise you, but if you go back to his 2013 shareholder letter, he put in there some information for the trustee of his estate. So once Warren passes away, someone's going to take his estate over, and all the cash generated by Berkshire Hathaway and Burlington Northern and Geico and all these huge businesses are start to get dumped over into this trust of his. And he said, my advice to the trustee is this: put 10% of the money in short-term government bonds and 90% in a low-cost S&P 500 index fund. That's it. That's what he said. Because he basically said, I want to have the highest degree of certainty that we outperform inflation and grow this money and do so with a reasonable level of risk. And he just said, this is the best way to do it, in my opinion. And it's interesting, right? Because this is a guy that's very famous as an active investor, basically telling the person that's going to be in charge of the money to protect his wife, put this in an index and just don't do anything. And the bottom line here is you got to stay fully invested. So any plan is only as good or is only going to work if you're able to follow that plan. So if you're going to try to time the businesses, if you're invested in the index right now, there's a piece of your portfolio that's invested in Amazon. And this is Jeff Bezos. And he's one of the smartest people on the planet, one of the richest people on the planet. And he also owns a lot of Amazon stock. So every night, Jeff Bezos is laying in bed at night and he's thinking about, how do I make, I don't know what happened there. It just swooped down. So I hope you guys are still seeing this. But Jeff Bezos every night is saying, how do I make my $100 billion, $200 billion? That's what Jeff's doing. And I like that as an index investor, because I know tonight there's 500 companies. There's 500 CEOs that right now are thinking about how to grow my money. There's 500 chairwomen that are thinking about how to grow my money. And some of the best and brightest, some of the most aggressive business people, they're all working for you. They're on your payroll working for you. And I think if you say, hey, I think I can time Amazon or something, I think you're crazy. And I think you're really, really playing a losing game. And I also would say, don't attempt to time the market. So this is a little bit covered up here on the screen, but Gary Hulbert, who's kind of a famous newsletter guy, went back and did a study that went into Business Week back in 1998. He looked at a 10-year period and said, if you adjust for taxes and frictional costs, none of the newsletter services beat the market. So think about that. If you adjust for taxes, none of them, all the newsletters, all the mutual funds. So we're literally saying 96% of mutual funds adjusted for taxes don't beat. And we're saying that 100% of newsletters don't beat over this 10-year period. Now, might they beat once in a while? Sure. But we're talking about over a 10 or 15-year period. This is extremely hard to do. And in fact, one of the smartest people to ever live, Isaac Newton, lost most of his money trying to time a market. It was a South Sea bubble. And he said, I can calculate the motions of heavenly bodies, but not the madness of people. And I think that's a really interesting quote, because he basically thought, yeah, people are rational and they're going to see, where the values are, and I'm going to be able to time things. And he got torn apart pretty bad. I think he ended up losing like 95% of his net worth. But let's talk for a split second about a successful market timer. So this is a unicorn. This is a guy named Jim Simons. He founded a company called Renaissance Technologies. And going back over the last 30 or 40 years, they've done 40% compound annual growth rate. So there's all sorts of like magazine articles about him and different people trying to figure out what his strategy is and different things like that. But he's one of these people that's up in that 99th percentile type of range, that it wasn't just dumb luck. Some people that get up in that realm, it's just dumb luck. They put all of their money in Tesla and it worked out, or they put 100% of their money in some crazy high risk mining company and it just happened to work out. But for the vast majority of people that are up in that area, it's really luck. For some of them, it's skill. So for a guy like this, for a Jim Simons, it's skill. But here's the thing about Jim: 40% annual growth rate net of fees. There should be clients knocking down their door to try to get in there. He's not open to outside investors. In fact, once they figured this strategy out and he figured out how he could basically consistently generate, 3 or 4% a month, they actually fired all their clients. Because if you think about it, if he's got $1 billion and he knows he can generate 400 million, he doesn't have to talk to anybody. He doesn't have to explain anything to anybody. Anyone that can consistently do this, and I really believe there's a handful, I believe there's 5 to 10 in the United States that can do this, they're not taking investors. Okay. They're not interested in clients. They don't need them. They know how to go make 30, 40, 50% a year. So think about that the ones that are up there that are really drastically outperforming are not available. What does that mean to all of the other funds that are available? Well, most of them, if we just look at what an average is, all the pluses, all the minuses, that means most of the remaining things must do way worse. If he's doing 40%, there's somebody doing, negative 40%. So think about that. It basically means that if you just choose to not participate in trying to win, you're going to be ahead of all of those people trying to win that are trying to compete with Jim Simons. They're not going to be able to do it. So what I would say in general is just don't interfere. And I want to move I'm going to move my face back up here because I got a picture coming up. So just don't interfere. Regardless of how it might feel sometimes like you're not moving and things aren't working or whatever. Charlie Munger has this great quote where he says, someone will always be getting richer faster than you. This is no tragedy. And the first time I heard that, it's one of those hilarious lines. If you don't know who Charlie Munger is, he's been Warren Buffett's business partner for 40 years. Very smart guy. I would say the best investor to ever live. But when you look at his approach to things, he doesn't trade very much. You know, in a given year, he'll trade 3 or 4 times and that's it. And a lot of times he's adding the things he already owns. He's selling some things that are losing. So he's a little more active than I would be, but he's got some great psychological views of trading. You know, he says the real money is not in buying or selling. The big money's in waiting. You know, he has this line where he says, the great majority of the wealth that I've made in my favorite position. You're like, oh, is that stocks? Is it some sort of crazy option deal? What is it? What's his favorite position? And he says, sitting on my rear end. And he's right. You know, the vast majority of the wealth you're going to make is by not interfering, creating another tax liability, creating another fee, creating another expense. Just stay out of the way. You have the best businesses in the world. You have both of these guys working for you if you own an index fund, because the index owns Berkshire Hathaway. So they're all just trying to grow their businesses. And that's really the play here. And the overall philosophy is you want to own a bunch of businesses. You also want to stay fully invested. Just don't monkey with it. There's too many people that are going to try to monkey with it. A lot of mutual funds out there, you know, not only are they holding high cash balances, the average mutual fund's holding 6% cash. Well, if you have 6% cash and the market doubled over the last 5 years, which it did, not being invested cost you 6%. So it cost you a little bit over 1% a year, because the average mutual fund didn't have 6% of your money invested. I would say they should add that into the expense ratio, because you're keeping some cash in the bank and you're keeping some cash in your brokerage account. You don't need to also keep cash in the mutual fund, if you're following me. And also on the capital gain side, when you invest in a mutual fund, they have tax control of your account now. They get to decide when to buy, when to sell, when to distribute capital gains, how much dividends, all these sorts of different things. And I can't tell you how many times we've seen somebody's tax return get completely blown up by a mutual fund just deciding to release a capital gain. And we already went through that stat that 89% of all mutual funds underperformed their index over the last 15 years. The average mutual fund has a fee of 0.79%. You can eliminate all this. You can eliminate cash drag. You can eliminate capital gains distributions. You can eliminate active timing. And what starts to happen is your performance ratchets way up. But I want to take a second and just take a quick time out, because a question that's probably going through some people's heads is like, wait a minute, though, if you're telling me to invest in the market, what happens when it crashes? And it's a very good question, because when we look at what these dots are, each one of these dots is the biggest pullback inside of a year. So for example, I wish my mouse was showing up, but it looks like my mouse isn't showing up on the screen. In one of these middle years, what would it be, like 2003, where it says 26. So kind of right in the middle of the screen, there's a 26% bar. Down below that, there's a circle, there's a dot that says in the middle of that year, it was down 14%. And on average in a given year, really common for the market to be down 10, 15, 20%. Even 30, 40, 50% is common if you hold long enough. So if you're in there for 10 years, you're probably going to see a 40% pullback. And what I would say to you is that if you can't take the fluctuations, don't try an indexing strategy, because what'll happen is you'll become a trader. It'll go down 20%. You'll panic. You'll sell out. You'll get rid of it. What I would say is check out this book that I wrote. It's number 14 on Amazon in retirement planning. Go check it out. We go through a different approach for some of the safer money that can outperform inflation, outperform bonds, outperform cash, different things like that. What we're really talking about during this webinar, during this Wealth Wednesday, is your money that's invested for growth. The long-term money that you don't need for 10 years or more, how to invest that for growth. So I'm not saying money you need a year from now should just throw it in an index fund. I would not recommend that. We've done some other videos in the group about safe money. I would also say go back down to some of the older Wealth Wednesdays. I have one Wealth Wednesday on the new 60/40. If you'd like to just watch that and see some of these safer money alternatives for money that you might need in the next 5 to 10 years, happy to share that with you. But today we're talking about growing the money. So again, you want to own a bunch of businesses, great businesses. You want to stay fully invested. You want to keep your costs very low. My favorite, most quotable guy ever, Benjamin Franklin, he has this quote: small leaks sink great ships. And I think the full quote is something about expenses, like beware small expenses or something like that. Small leaks sink great ships. And I think a lot of people are really underestimating this. So if you have $1 million, you have $1 million portfolio, you invest it and you get 8% for the next 30 years, no withdrawals or anything. You just get 8% for the next 30 years. It grows to $10 million. If we just subtract 1%, so just literally a 1% fee, something like that, that same $1 million invested for the same 30 years, if it only grows at 7%, only turns into 7.6 million. That is a $2 million loss due to a 1% higher fee. So think about that. Okay, we're talking about $1 million investment that if the fee is 1% higher than it needs to be, you lose out on $2 million in benefits over the next 30 years. Twice the value of the account, actually more than that, almost 2.5 times the initial starting value. If you have a $500,000 portfolio and you could cut your fees 1% and don't do it, you are going to probably lose out on something like $1 million over the next 30 years. And just think about that. That money's going somewhere. You know, there's a great book on Wall Street called Where Are All the Customers' Yachts? Think about that one. You know, all these Wall Street guys have these awesome boats and everything, but you don't see the customers having them. So again, own great businesses, stay fully invested, keep your costs down. If you do those three things, if you avoid mutual funds, avoid variable annuities, avoid these expensive things, stay invested, own great businesses, don't monkey with them, don't try to time anything, you will literally move. The average investor will move from 2.3% a year up to 9.8, 9.9% a year. And we haven't even gotten into like tax planning and other things you can do to actually improve your results beyond that. But just remember, this is not me saying this. This is Charles Schwab. This is the S&P. This is David Swensen. This is Warren Buffett. This is Vanguard. These are some of the best people in the world, in the world of investing. Charles Schwab in particular, he's made most of his money based on investors keeping large cash balances in their account. I don't know if you know that, but Schwab makes most of their money on interest on cash sitting in their account. And then otherwise it's the trading. You know, they're getting revenue from high frequency traders that are trading based off your activity and stuff. So when he's telling people not to trade, that's actually hurting his core business. So for him to say that, to me, I think is really telling. Like, I think that guy really believes it when he says it. So yeah, Charles Schwab, David Swensen, Warren Buffett, the instructions he left for the person that's going to be managing the money for his wife's estate. These are names that I would not write off. These are names I would take very seriously. And just to close out, I'm a couple minutes over, but I only have about 2 minutes left. So thanks everyone for riding it out here to the end. But the biggest advantage that I see in real life when a client goes from a super active, very frequent trading, very buy this, sell this, so-and-so is reporting earnings today. Once they go to more of an indexed approach, within about 6 to 12 months, they stop caring about the market. And it's really, really, really interesting. They'll be out hiking, they'll be out fishing or boating or, sailing or whatever, golfing or whatever the thing is. And they're not checking their phone. They're not going, oh man, so-and-so is reporting earnings in 10 minutes. And I got to see, if I'm going to be able to, go out to dinner 3 times this month, or if I got to cut back and go out to dinner once this month. My nightmare as a father, as a, friend is I don't want 20, 30 years down the road. Let's say, I get hit by a bus. I don't want at my funeral for people's memory of me, the mental image of me, to be that I was on my phone checking stocks and thinking about all these different things and always worrying about like what the market was going to do and this, that, and the other thing. To me, what I want him to remember me as is like, yeah, he taught me how to fish. He showed me this really cool trick on this saw. I do a lot of woodworking and stuff, different, the things that I like to do, the things that my kids like to do. And I don't believe that you will have the same quality of life in retirement if you are a super active investor that you will if you're an indexer. If you just index and you just say, I'm going to invest like Warren Buffett, like his personal money, like his personal estate, his estate for his wife. I'm going to invest like Charles Schwab. I'm going to invest like the Yale Endowment. I'm going to do that. You're really going to be left in a much better spot. Psychologically, you're going to make better decisions. This is going to sound crazy. We had clients that over the last year have retired. And even though it was a pandemic year and the market traded down 35% and stuff, their psychology was solid because they understood what they owned. They owned all the great businesses in the world. I had a guy say, it's not like Disney is going to stop putting out Frozen movies because, because of a situation that's going on. Like they'll make them differently. It might take them longer to make it or whatever, but they own the greatest businesses in the world and they're really not scared. They know that their income, by the way, for the next 5-10 years is not tied to the market. So that the rest of their money, which for most of them is the bulk of their portfolio, can be invested in the biggest businesses in the world. And I practice what I preach. I eat my own cooking. All of my retirement assets, all of my Roth IRAs, all my wife's Roth IRAs, they're all completely indexed. Okay, so think about that. I'm supposedly this, hot shot former hedge fund, blah, 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 whatever, which my record's pretty good, by the way, but I just index, my Roth, I just index it. And I really believe that there's a 96% chance you can't beat that. And by the way, some of the people that are up in there are very skilled and you can't get their money invested with them. And a huge proportion of the people that are in there are just lucky. So you're probably talking, there's a 1% chance that there's a skillful person that is open to investor assets that will actually pull it off. And what you're risking is 5% underperformance or something like that, or even in some cases 10 or 20% underperformance. Or you could just take the index approach. You can take the route of, I'm going to go play with my kids. I'm going to index. I'm going to let the smartest people in the world fight over what this thing's worth. And I'm just going to get the average over the long haul of what the business is worth. I'm not going to try to time things. And also, just enjoy life. Life's too short. You're not supposed to be glued to these things. You're supposed to be playing with the kids, playing with the grandkids, and just enjoying life. That's what retirement's for. And anyway, I've ranted and raved a little bit too long here, but I want to just thank you all for being on this Wealth Wednesday. Obviously, you've heard the line a million times. You don't need more money. You need a better plan. I would also say you don't need higher returns. You don't need higher results. You need less drags. You need less fees, less taxes, less trading, less worry, less fear. You don't need more money. You need a better plan. Thank you guys all so much for watching. I'm not able to see questions when I'm on this view, but I'll go back through at the end and make sure that I get to all the comments. If there's any comments or questions or anything, I know I was moving kind of fast. If anything didn't make sense, let me know. But thank you guys all so much, and look forward to talking with you all soon. Take care.